South African Reserve Bank Quarterly Bulletin has revealed a significant improvement on household debt matrix. The ratio has declined to 61.6%. Debt servicing costs also dropping to 8.5%. This has been attributed to nominal income growth, lower borrowing costs, higher economic growth forecasts, as well as improved business and consumer confidence. Nedbank Chief Economist Nicky Weimar speaks to us about these developments. Thank you so much for your time, Nicky. I think let's first unpack the highlights of this reading. What is it telling us about the climate for a South African consumer currently?
Yes, I think the good news here really goes straight to income. So personal disposable income has now been growing on a year-on-year basis in real terms, which is, of course, the bit that matters. We are now going into the fifth quarter of positive growth in real personal disposable income for households. Now, part of that is the result of higher wages and salary increases, which is obviously good for consumers, but also a big portion of that has to do with the fact that inflation has come all the way down, and we're talking of inflation at a whole different realm, which we are not used to, which is closer to 3%, so that's made a very significant difference to households' purchasing power. Now, against the background of income growing and real income growing, already the consumer's in a stronger position. And then I think you add to that the fact that interest rates have come down materially. And where we see that primarily is in the lowering in debt service cost ratio, which has come down at its peak. It was at 9.4% of disposable income, which meant that the interest portion on your debt alone consumed 9.4% of your disposable income. Now, that's come all the way down to 8.5%. And with that, of course, it means that your existing debt burden costs you less. It frees up funds that you can spend in a discretionary fashion, and it just makes consumers feel a little bit more comfortable, and they are capable of exhaling and not feeling as anxious as they have been since the pandemic.
Absolutely much needed relief for consumers, particularly going into the festive season. Where is the role for being prudent at this time? We do know that January, as it's sometimes termed and coined in South Africa, is around the corner.
Absolutely. So we always need to be careful, but I think consumers have been, to their credit. We see that in the credit numbers. They've been very cautious about borrowing, and you see that also reflected in the fact that income growth, nominal income growth, have outpaced new borrowing. So your total debt burden has come down to which you quoted earlier, to 61.6% of disposable income. So they've still borrowed at a very conservative pace. They've been very constrained from that front, and obviously, that means that they are in a pretty good position, I think, to enjoy this Christmas and hopefully enjoy this Christmas in a responsible manner.
Overall, as we wrap up, how much of this bodes well, especially looking at the inflation numbers that came out of Stats SA today? They too speak to what it is that consumers can at least save, but directly to the South African Reserve Bank in terms of expectations, where a further rate cut may be expected in January.
Yes, I think what it shows, the inflation numbers, actually, it was bang on our forecast. We anticipated that it would rise, that it would ease a bit from 3.6 to 3.5%. And that it would be quite a mild story, mainly as a result of the cut in petrol prices, which tends to be significant. I think the worrying bit there is meat prices are still rising at a very rapid pace. We are now again back up over 12% on a year-on-year basis. But set against that, all other food prices are coming down, so that looks good for the consumer. And I think the bit the Reserve Bank would take from that is that the sources of inflation at the moment really is very isolated. It is essentially meat prices. And if you look beyond that to core inflation, which is your broad sort of measure of underlying price pressures, they remain extremely muted and very close to the Reserve Bank's new target of 3%. They're at 3.2%. So I think in that context, it is reassuring. And it means that we're still sitting with fairly significant real interest rates, which suggests there is scope probably for further rate cuts in 2026, which, of course, feeds back to the consumer and is another positive twist that could help sustain consumer spending in 2026.
We'll leave it on that positive note. Nedbank Chief Economist Nicky Weimar speaking to us about the latest Reserve Bank Quarterly Bulletin. Good news for consumers on that front.